All right, let's talk about your biggest asset, your home. For years, you've probably seen a number on a website that claims to track its value, with the precision of a stock ticker. But here's a thought. What if that comforting little line on the chart? What if it's all built on a dangerous illusion?
Yeah, you know this page. You've probably checked it 100 times. You see the house, you see the price, and you see this nice, smooth chart that just tracks its value over time. It looks so real, right? So concrete, like a measurement. But hang on a second. Look closer. That chart is showing the price moving pretty much daily or at least weekly. And that should make you ask a question. I mean, think about it. How could anyone possibly know your home's value changed by some precise amount last month when it hasn't even been for sale? A stock? Sure, it trades thousands of times a day, creating a real price. But a house? It might sell once a decade. So where in the world are these daily movements coming from? Well, the answer reveals a pretty fundamental misunderstanding that, honestly, can cost you some serious money.
So, if you want to avoid that risk, we've got to pull back the curtain on this whole illusion. And here's the big reveal. The chart you're looking at, it isn't actually tracking what the market did. Nope, it's tracking the behavior of a predictive model. And this is the big mistake, what you might call a category error that trips almost everyone up. You think you're looking at a measurement, like the temperature outside. But what you're really seeing is just a statistical prediction that's been packaged to look like a hard fact. It's not tracking reality, it's just tracking its own updates.
So, how do they get that nice, smooth, stock market-looking curve? Well, it's a little trick called temporal smoothing. Let me explain. Imagine your neighbor's house sells for, say, 50 grand more than your current online estimate. Now, instead of your home's value jumping up overnight, which would look chaotic, the model just slowly blends in that new info, day by day. It creates a gradual but totally artificial curve.
And here's where it gets really interesting. Think about this. If a model has a built-in uncertainty of, say, $30,000, but it reports a $7,000 move last month, well, that's not measuring reality. It's just measuring the model's own internal noise. That little blip on the chart, it's not a market signal. It's just the algorithm tinkering with itself, and we're seeing it presented as real-world movement.
Okay, so this isn't just some, nerdy statistical curiosity. This illusion of precision, it creates really dangerous financial anchors. And these anchors can absolutely trap investors and homeowners, leading to some very, very real consequences. This trap is powered by something called a reflexive feedback loop. It sounds complicated, but it's not. Basically, it's a circular dynamic where the model's prediction starts to influence an action, like a list price, and then that action feeds back and confirms the original prediction. It becomes a self-fulfilling prophecy that can be totally disconnected from what the market is actually doing. Let me walk you through exactly how this financial trap works. Step 1, a realtor suggests a price based on one of these online portal estimates. Okay. Step 2, the portal's algorithm sees this new listing price and thinks, hey, fresh signal. So, step 3, the estimate updates itself to get closer to that new asking price. And then, here's the kicker, step 4, that updated estimate is now used as proof that the asking price was correct all along. You see the loop? This is exactly how people end up overpaying for an investment or leaving money on the table when they sell. So, how do you break out of this crazy loop? Well, it takes a complete shift in how you think about home value. We have to move away from chasing a single, magical, and frankly illusory number and start embracing a much more honest and useful framework. As the founder of ClearValue RE puts it, price is a probabilistic outcome, not a property of the house. And that is the core idea right there. A house doesn't have a single intrinsic value stamped on it. What it has is a range of possible sale prices that depend on all sorts of things: timing, marketing, even which specific buyers happen to show up that weekend. Price isn't some fact we have to discover. It's an outcome we need to predict. And this really illustrates the shift in mindset. A savvy investor doesn't just ask, what's the number? No, they ask, what are the plausible outcomes and what's driving the uncertainty here? The goal isn't to just get a single answer from some black box. The goal is to build a real framework for your own analytical judgment. Okay, so what does a framework for judgment actually look like in practice? It's all about moving away from that black box and toward a transparent tool. And the difference is, well, it's night and day. On the left, you've got that false simplicity we've been talking about, that single, smooth line that hides all the risk and uncertainty. But on the right, that's what we call actionable complexity. It's not a single neat answer. It's a visualization of the raw sales data, the model's fit, and the real uncertainty.
It's a tool for analysis, not some magic oracle. And these tools are built with some key things in mind. We're talking about actionable probability bands at 68 and 95% confidence, multi-method sensitivity checks. You get full data contestability. And critically, it separates the real signal, that's the actual sales, from the noise, which is just the listings. It even lets you audit the assumptions being made. Total transparency. So what does this new approach, this ClearValue RE advantage, really mean for your bottom line? It means you get to make much, much sounder decisions. Take this, for example. Instead of just one simple price trend, a better tool can actually separate the long-term trends from the totally predictable seasonal cycles. This gives you data-backed timing advice, so you can answer the crucial question: are prices going up because the market is genuinely hot, or is this just the typical summer peak we see every year? I mean, that distinction is absolutely critical for making a good decision. So, the outcome for a savvy decision maker like you is pretty clear. First, you mitigate your risk because you can finally see and understand the uncertainty. Second, you can negotiate with real, market-clearing evidence, not just some vague estimate. Third, you can avoid getting trapped in those reflexive feedback loops we talked about. And finally, you can optimize every single decision for quality, not just engagement. And really, here's the bottom line. The goal isn't to replace human judgment. The goal is to make that judgment informed. The best technology doesn't give you a magic number and tell you what to do. It gives you a clear, transparent baseline so that you can apply your judgment, your knowledge about that brand new kitchen, or the premium view that a model could never truly appreciate. That's what ClearValue RE is all about. Price prediction you can reason about. Because when the stakes are this high, a single number just isn't good enough. You need a tool you can actually work with. So you have to ask yourself, are your decisions being guided by a real signal, or are you still just looking at the illusion?